Hi folks, this is Mike Zlotnik, Big Mike, and today we're going to have a short video recording on commercial real estate mortgages, rate caps, essentially insurance policies on commercial mortgages to protect against interest rates going up. And also we'll compare and contrast that versus residential mortgages. So the usual disclaimer, this is for informational educational purposes, no advice of any kind, no solicitation of any kind. If you're interested in any of our funds or syndications, consult with your attorney and CPA professional before making any investment decisions. Now let's talk a little bit about commercial versus residential mortgages. So commercial properties such as multifamily, office, self-storage facilities, often industrial complexes, warehouses, hotels, and other commercial asset classes are all grouped as one commercial. Of course, they're all different, but just for sake of this conversation, let's just think of all the commercial asset classes as one. And residentials are typically 1 to 4 doors, single family, duplex, triplex, or quad. So the mortgages offered on those are typically 30-year fixed mortgages. Sometimes you see 15-year fixed. Also in the residential space, we've seen quite a bit of adjustable rate mortgages, 3-1 ARMs, 5-1 ARM, 7-year ARM, etc. So that's what they function in the residential space. Residential space is very, very common for buyers or the owners to finance with fixed rate mortgages, especially was very, very, very popular when the interest rates were low. In the commercial space, there are 2 primary options. One is a fixed rate mortgage, but it's fixed for some amount of time. The most typical period is a 5-year fixed. Well, the loan itself may be a 20-year amortization loan, but the interest rate is fixed for 5 years. So that's a very typical product in the commercial space. Of course, they're different a little bit. Bank by bank products differ. They're less compliant or standardized in commercial space versus the residential space. Residential space, Fannie Mae, Freddie Mac back most of the mortgages. It's very, very, or other agencies like HUD, for FHA loans, etc. So let's go back to the commercial space. There are fixed period of time mortgages, typically 5 years. In some extreme cases, you see 7 to 10 years, but you rarely ever see 30-year fixed mortgages in commercial, almost non-existent. The only exception would be HUD loans, could be a 40-year fixed HUD loans, but those are very rare and only happen on the certain properties. So for commercial, you see 5-year maturity is a very, very standard typical period of time, at which point interest rates resets to the market. In the commercial space is also floating rate mortgages. These essentially are adjustable rate mortgages, and they adjust frequently. They adjust on monthly basis. They can adjust on weekly basis. They can adjust on quarterly basis. But the most typical thing is a monthly adjustment. So these floating rate mortgages were very, very popular, or still very popular, on value add projects. So compare and contrast, if you're buying a stabilized property, a property that is at 90 to 95% occupancy, it's performing, it's generating stable, predictable income, you can go to the bank and request a long-term permanent loan on the property. So those permanent loans would be 20-year term with a 5-year fixed interest rate period. Compare and contrast that to a value add project. So value add project is a project where there's some improvement to the property and the fixed rate mortgage is either not available on the property or completely not a profit. So here are some examples. If you're converting an old office building to a self-storage, or you're converting a hotel to multifamily, or you're doing ground up construction or redevelopment, any of these major renovations, no fixed rate product is available at all because there's repositioning of the property. If on the other side, you have a value project where you're renovating units and then planning to increase rents and then refinance once the property is stabilized or all the rents are brought to the market with the renovated units. These projects may still get fixed rate financing, but they're very rare. Most of these projects prefer to get floating rate mortgage bridge loans. They're known as bridge loans. These bridge loans effectively provide much more flexible capital on the projects that are not ready for permanent financing yet. So it's a very different world in the commercial versus residential space. Residential space, typically there are no prepayment penalties. In commercial mortgages, there are prepayment penalties. If you get a 5-year fixed mortgage, you're typically locked into that rate. And if you prepay early, there are penalties. In the commercial space, sometimes they call it yield curve maintenance. Why it happens? Well, the reason it happens is because as the mortgage gets originated, it gets turned into a bond, and bond gets sold to investors, and investors want to get paid for the contractual obligations. So most of the commercial mortgages have prepayment penalties, while most of the residential mortgages do not. And that's one of the big advantages in the residential space. When the rates were low, it benefited to lock in low rates. There was no risk, there was no downside. If the rate dropped further, you could always refinance with low rates. If the rate went up, you had an insurance policy, a protection for 30 years from the interest rate spiking. So it's a very powerful benefit for residential, which is most of these residential 30-year fixed mortgages were effectively subsidized by the government through the Fannie Mae, Freddie Mac, and similar government agencies. In the commercial space, that didn't exist. So most of the loans that we've seen being taken in a commercial space have been either 5-year fixed maturity, or the loan had 5-year fixed interest rate and maturity was 10 years or 15 years or 20 years. So from that perspective, the borrowers only have to worry about the rate reset in 5 years. Floating rate or variable rate mortgages have dealt with variable rate. And the reason, again, they were perfectly happy with that methodology is the value add projects typically increase value substantially, increased rents, created much better valuation for the property, and then they could be refinanced. So some of these floating rate mortgages also bought an insurance policy or equivalent of called rate cap. So rate cap is not to be confused with cap rates, which we can discuss a little bit later. But rate cap is a policy where the owner of the property would buy an effective financial contract where if the interest rates went above a certain level, contractual level, then the policy would start paying investors monthly payment to compensate for any amount the interest were above that rate cap. So for example, when the interest rates were very low, let's call them when the mortgages were, let's use an example. The Fed funds rate was trading near zero. And then you could buy a 2.5% cap rate policy where any interest increase in the Fed funds rate above 2.5% would be insured and would be paid for by the contract. So when the Fed pushed their interest rates way above 2.5%, these cap rate policies started to pay investors. So this is a form of insurance policy. It's a very powerful mechanism to protect against rates going above a certain level. So these existed on commercial deals, and many sponsors, operators, developers bought these policies as an insurance way to protect for the time being. And typically these cap rate policies have certain maturity. It could be 1 year, 2 years, in some rare cases, 3 years. So that's how they function. So commercial mortgages effectively can help properties through the transition phase, or value add phase, versus stabilized phase. And typically most of the projects are either in transition, some kind of value add improvement, where they gravitate towards a bridge loan, versus stabilized projects would typically want to get a long-term financing. At a long-term simply means it's a typically 5-year fixed. So those are the two different scenarios. They've been around for a long time, and they still exist today. And probably they'll continue to exist, where stabilized properties, and again, stabilized in self-storage, multifamily, industrial, retail, open-air shopping plazas, et cetera, all prefer, once they stabilize, to get a fixed rate debt. The longer the duration, the better there's predictability of the cash flow. And the reverse is true on the fixed rate side. These policies, on the variable floating rate mortgages, these are designed for a short duration, typically 2 to 3 year term. In some extreme cases, a little bit longer, just to provide the capital necessary for the project to execute its business plan and then be prepared for refinancing into the fixed rate debt. That's how it works in general. Just wanted to give you a quick overview. And if you have further questions, please reach out. But this is, again, just a little bit of an overview how these products worked in the commercial versus residential real estate. Thank you.